Hello and welcome. I'm Adam Camillo from Associate Global Partners. Today I'm joined by Jason Teh, Founder and Chief Investment Officer of Vertium Asset Management. Jason, thanks for joining us today.
Thank you for having me here.
Looking back in the past year, could you give us a bit of an overview of what you saw as the key market events and trends that sort of significantly impacted the fund itself?
Yeah, sure. Look, from a market perspective, it was actually a pretty volatile year. At the beginning of the year, we had a regional US banking crisis, and the Fed actually tried to save it by increasing liquidity into the system. But beyond that, it was interest rates that actually drove market behavior for most of that year. So when rates were rising, markets were falling. And then towards the tail end of the year, October, November, rates began to peak out, began to fall, and then when the Fed hinted that they could actually pause their rate hikes, the market really rallied towards the end of the year. So in terms of our experience, in terms of delivering stable returns for unit holders, it's been pretty steady, avoiding the big drops in the middle of the year, but then also not sort of rallying aggressively towards the end of the year. So I guess from our process point of view, we're more interested in providing more consistent returns.
Interesting question, obviously, from a portfolio management perspective with the market volatility. From a portfolio management perspective, how are you trying to negotiate those challenges in a little bit more detail, like you mentioned?
Sure. So from a portfolio perspective, we're always trying to control the risk profile. In our terms, we call it portfolio beta, right? So portfolio beta is a sensitivity to market movements, and we try to control that to be below 1. So hence, we're always going to be less sensitive to the market. So if the markets are, falling or crashing away, we'll be preserving capital very well. And when markets rip up on the upside, we won't sort of necessarily match the market behavior in a very strong bull market, but by controlling that risk profile, it provides that smoother risk return profile to clients.
And then can you talk a little bit more just around the key drivers of performance in the last sort of calendar year from your perspective? Was there sectors or industries that sort of drove returns or, didn't in certain instances?
Yeah, so two stocks that performed well for us was Goodman Group and James Hardie. So, you think about those two types of stocks and, I guess their industry exposure, they are actually quite rate sensitive from a sector perspective. So we don't allocate based on sector views, but we allocate based on disconnects where we feel that these stocks are, the share prices are disconnected away from their fundamentals. So these two stocks were actually, very weak when rates were rising, but it provided an opportune time to actually invest in these two stocks where they are industry leaders in their respective sectors. So for Goodman Group, you look at the share price, it's actually approaching its all-time high back in 2021, despite the fact that its PE multiple is actually quite low because the market still fears that rates would rise. But the reason why the stock has performed well is because the earnings growth has been quite resilient for this company. And James Hardie, a little bit more cyclical, from its exposure to US housing sector, but the US industry is actually facing a structural undersupply of US houses. So James Hardie should actually perform quite well when rates stabilize and the US housing sector potentially takes off this year.
And then you mentioned risk, obviously with very volatile markets in the past 12 months, managing risk being critical and not just from a portfolio management perspective, but overall, how do Vertium approach risk management at a portfolio level for the fund?
Sure. So a very good question actually in regards to managing risk. So most people think managing risk is just buy the lowest risk stocks. And if you did that last year, let's say you bought the grocery bellwethers such as Woolworths and Coles, you would have significantly underperformed. Buying low volatile stocks such as Coles and Woolworths can still destroy returns. Managing risk has to be done at the portfolio level. So, like I mentioned before, controlling the portfolio beta while taking, bets or educated, concentrated bets in stocks that are dislocated from their fundamentals allows us to generate decent returns while holding that risk profile by providing that insurance-like policy when markets are quite volatile.
That's great. And then, so looking forward, start of a new year, the markets ended on somewhat of a euphoric note at the end of last year. What's your outlook for the markets this year, both domestically and also globally?
Yeah, so the market did certainly finish on a very strong note. I think the Aussie market was up a little bit more than 7% in December, right? So that is a very strong month. The market actually has re-rated from a PE perspective without any confirmation of earnings rising. So the market is fairly extended. So we really do need to see earnings rise to actually support the market. Without an earnings, or revisions coming through from the general stock market, you could actually see a bit more volatility in the stock market. So the markets are still currently rate driven, so with rates potentially on the rise again, that could actually put pressure on markets. But it could also generate more opportunities as well. Like I said before, when people feared the potential of rising rates, it affected Goodman Group's and James Hardie share price. It could create other opportunities when that occurs.
And then, so in terms of obviously taking from last year into this year, is there anything right at the moment that you're doing to position the fund for success in this calendar year? Obviously, the information is still flowing through the markets. Obviously, what happens with rates is going to have a large impact on certainly the first quarter of this calendar year. Is there anything specifically you're doing at a fund level now?
Yeah, so I guess the core of our process is to always look for dislocated, stocks from their share prices versus their fundamentals. So I mentioned about James Hardie and Goodman Group, where the fear of rising rates created these opportunities in these particular stocks. But then on the flip side, where now that everybody's talking about falling rates, QBE sort of stands out as a potential investment. Where the stock is on a P of 9. It's actually one of the cheapest industrials on the market, and the market thinks, obviously, on such a low PE, it's probably peak earnings, but the stock is so cheap, it creates a huge margin of safety that even if the earnings come off, provides a buffer where we don't think the stock will come off so much, if rates do fall, because of that huge, gap between where the share price is versus fundamental value.
And you mentioned a couple of really good examples. Is there any other industries or asset classes that you see that are either promising or potentially challenging this year for the fund globally?
Yeah, so look, there's one sector that we are looking at very closely. And in fact, many Australian investors should be looking very closely is actually what happens in China. Right, China dictates, pretty much what goes on in our resource space. So, towards the tail end of last year, the iron ore price actually, went up quite a lot, pulling our iron ore mines with it, and it went up because of the tight inventory situation in the iron ore market. But when you look at most demand, profile in China, it's actually relatively subdued, right? The heyday of strong demand, prior to the 2007 period, right? It's just non-existent in China. So, I think that's one industry we have to watch, because if that demand profile remains tepid, we may see the iron ore price come back. So it's definitely one to watch.
Yeah, absolutely. And then lastly, on a very positive note, last year you were awarded two awards for the fund itself. Can you share a little bit more about those awards, and how do you also think that the accolades, reflect the effectiveness of the investment strategy as well?
Yeah, so we're really pleased and grateful that the industry has recognised our efforts, which validates our commitment and that we have delivered consistent returns for clients. I think the industry has slowly moved away from just looking at total returns, because when we manage money for retirees, it's about risk-adjusted returns as opposed to total returns. We're not aiming to shoot the lights out, but we're aiming to deliver consistent equity-like returns. So if we can deliver that with a smoother profile, or the way I like to describe it, an insurance-like policy against market volatility, we actually add a lot of value to clients' portfolios.
Yeah, well, congratulations. Obviously, accolades are a brilliant reflection on the strategy and the team as well. So, Jason, thank you very much for your time today. Much appreciated.
Thank you.
To find out more about the Vertium Equity Income Fund, please visit the website at vertium.com.au. If you have any questions, please feel free to call the team on 1300 052 054 or email invest@associateglobal.com. Thanks very much for your time.